Hello, everybody, and welcome to this joint webinar by the Alexander Group and Revenue Management Labs. You've got Kyle Ubilar here. Good to see you all again. And I'm joined by Avy Punwasee from RML. We are really excited to share this topic with you today. It's timely, it's interesting, and I have to tell you, we've got a lot of content. So put your seatbelts on and let's enjoy the next 35, 45 minutes together to really learn a lot about pricing strategies and execution of those pricing strategies in times of difficult change, many of the things that we're all going through right now. Avi, it's an interesting topic, wouldn't you say?
Definitely. I think it's timely as well. For sure, a lot of companies are looking at it now.
Exactly. For some of you, this might be your first introduction into pricing strategies and really kind of beyond that first dip of the toe of the water. For others, this might be a review of things that you already know. So kind of take notes both ways. If this is your first introduction, really this is a great sort of primer on why it's important and what it looks like to go forward. For those of you who are pricing specialists and been doing this for a long time, I think you might learn a thing or two here, or at least provide a checklist of the things that you should be doing. So, hey, let's go ahead and get into it, Avi. As we move forward, kind of thinking into the big picture, why is it important right now? What's actually going on with this whole concept of pricing?
Yeah, I think in terms of why is it important right now, we just got out of a pandemic and we're seeing a lot of commodity costs come up. I'm sure you're seeing things like steel, transportation, freight, logistics, and and with the labor disruptions, everyone's talking about what's going on in terms of the hyperinflation, not only in 2021 and 2022. So companies are being forced to re-examine what are they doing from a pricing strategy perspective, and as opposed to just looking at the costs that are flowing through and how that translates, how can they do it in a smarter way, and what makes sense for the company and what makes sense for their customers as well.
So maybe just a quick introduction of who we are and how we come to bear at this topic. Again, I'm Kyle Ubilar with the Alexander Group. For those of you who don't know AGI, we are a revenue management consultancy. Think the commercial function, marketing, sales, and service teams as a sort of a global footprint of a consultant. We do worldwide work with the largest B2B clients out there, work particularly well with a lot of private equity companies as well as the smaller organizations. So my personal sort of remit within AGI, I run the manufacturing and distribution sector for us, but at the same time, we kind of take that big picture look of how do we actually get the most out of our teams in order to grow revenue or top line revenue. Avi, you want to talk a little bit about RML?
Definitely. So I'm a partner at Revenue Management Labs. We focus purely on strategic pricing, helping both B2B and B2C companies figure out what value they're providing and how they can translate that value to the market. What's interesting and why we're on the call with Alexander Group today is often as we get to the implementation portion of that, how the sales team brings that to life in the market. We found a lot of synergies with working together, and we've worked a couple of projects together as well.
Thanks. So let's go ahead and get into it, Avi. I mean, if we think about the big picture, today's agenda is what is strategic pricing? Let's talk a little bit about what it is and why it matters. And then more importantly, as we get to the back half of our conversation today is like, what do we need to do? How do we actually take action against this? So let's start it. Tell me a little bit more about your point of view, the points of view that are most contemporary right now about strategic pricing.
Yeah, definitely. It's probably the main question we get is, how should we think about price? And how we try to think about it is typically people talk about revenues price times volume. And we think about it a little bit more widely, that revenue is for sure your price and understanding where your offer's value is and how you optimize that. The next element is volume. And when we think about volume, we're often making investments to go and get volume. So we're providing special discounted pricing, we're providing customizations to the customer, we're providing guarantees to them, whatever it is. So as we think about those investments, how do we think about the return we're getting on those investments? And are there ways that we can reallocate them or optimize them to drive more top line out of those investments? The third area is mix. And how you should think about mix is if we're able to encourage customers to make different decisions, for example, to move from service package A to service package B, or we're able to sell in one channel over another channel, or we're able to migrate customers into our new innovation or convert them into a new offering, are we able to get natural revenue and profit uplift or customer lifetime value uplift? So those are kind of the three core areas around strategic pricing, trying to pull levers in those areas to drive more top line and bottom line. And then there's two levers that really supports, and I know Alexander Group really helps in these areas. One is, how do we take the insights from price, volume, and mix and translate that to the market and evidence our value to customers? And the second piece that this all sits around is what we call enablers, making sure that you have the right infrastructure in place to set up your strategic pricing, the right people, the data, the reporting structure, the targeting, a lot of the things that Alexander Groups works with as well.
Mm-hmm. Yeah, we think about this, Avi, in particular, and I think that's why this story is so powerful, is that, hey, it's not just about price and volume and mix eventually, because that matters today, especially when we've got, scarce resources that we're trying to sort of direct or guide different buyers, different segments to different directions. It's the last two pieces and that power of the multiple, in particular about the enabler, that actually kind of makes you realize those price strategies.
Yeah, and the funny thing is you don't realize the enablers on how important they are until, so the only organizations that we work with, and you can always come to great insights. If you've got the data or you're doing the work with the team, you can always come to great insights and uncover areas of opportunity. But you really find as you transition to the execution, and if you don't have the right, for example, if you're going ahead and you have a really well-rationed price increase that you're going out there and taking to the market, but your sales team is comped on revenue growth, and you're already predicting that given this price increase, we're going to lose a couple of customers, we're going to lose a little bit of volume, but we're going to be way better from a profitability standpoint and way better from a capacity standpoint and whatnot. Well, our enablers, we already know we're a little bit behind the ball on where we need to go, and it's, instead of getting kind of the 100%, we might realize 40%. So it's really important that we have that holistic approach to what we're trying to execute.
That's right, and I think that what we're going to try and demonstrate throughout the rest of this conversation this morning is all those enablers interact with one another, but it actually kind of all starts with just the power of 1%, doesn't it? I mean, and I think this is the key that really helps to tell the story.
Definitely, and this is just a very simple financial statement. It's the average S&P company in 2019. We've proxied the units and the revenue per unit just to walk through and help people understand the power of 1%. So long story short, they're selling about 1.1 million units for $5,700 per unit. Gross revenue about 6.5 billion, 13% around discounts. You're making about 5.3 billion in terms of net revenue. Your COGS is around 30% of that, around 1.7 billion, 3.6 billion gross margin, fixed costs around 2.4. At the end of the day, you're making about $1,268 million in terms of profit, or about a 19.6 margin. So as we think about it as leaders of our business and how we can start pulling levers on the financial statement, often the first place we think of is cost. Let's pull cost out of the business. So if we took 1% out of the cost, the 1672 drops to 1655. That drops straight to the bottom line, and the 19.6 improves to 19.8%, or you get about a 1.3% improvement. And we know there's been a lot of focus on driving cost out of the system. Of course, some of the headwinds now are driving more cost back into the system. The next area that we can think about is volume. How do we drive 1% of volume? So if we were able to add 1% in terms of our units that we're selling there, our revenue would improve, our discounts stay at the exact same percentage, We see that improves from 53.13 to 53.66. Our costs go up a little bit because we need to produce it. Our fixed costs stay the same. We improve to about a 19.9 or about a 1.8% improvement, which is great. We've driven more profit dollars to the bottom line. Again, often companies are highly focused on this, on how do we drive more volume, how do we get more share and get our velocities up there. The last area is price. So if we were able to get our price up, and when we think about price, I want you to think about price, how we were talking about the prior slide, our price in terms of how we're changing our prices, what we're doing from volume investments, and also how we're managing our mix. We're able to get that average price to go up to 57.43. Our revenue goes up. We're still selling to the same number of customers, so the discounts are staying the same. Our costs are staying the same. We're not producing any more volume. Our fixed costs stay the same, so it's all dropping to the bottom line. And you can see the improvement that we're seeing, about 4.1% or much more dollars on the bottom line. So if you can figure out how to drive that price improvement, it's a pretty significant ROI to the business because it drops to the bottom line if you're doing it properly.
Yeah, I mean, that's the thing that we see. I mean, it's a compelling story, and I think anybody who's done any kind of finance understands this 1% power and the power of pricing. But why is it so difficult? Why doesn't everyone do it? How can you find that 1%?
Yeah, that's fair, because a lot of people tell me, hey, I can do math too. Got it. But if 1% was so easy, can't we just go ahead and wouldn't we just go ahead and take it? There's a lot more complexity to it. So the question we usually get to is, one, can we get around that complexity, and is the 1% out there? So typically when we go into an organization, we see this graph, and I'll just explain to you what you're looking at. Along the vertical axis is net price. Along the horizontal axis is the customer size. Each of these dots represent a different customer. And I want you to think of this as, any product, any service, something that we've equivalized the portfolio on. But what you see is that all these dots really look like a shotgun at the end of the day. They're kind of all over the place. And we see that we have some very large customers that are paying really high prices. We have some really small customers that are paying really low prices. We would expect that there would be some sort of relationship. As the customers start to get bigger, we'd expect to see that their price starts to decrease. Now, the degree at which it decreases, it's dependent on the business and the customers and whatnot, but there should be some relationship here.
But what we find though, Avi, and I've seen these charts before, there's a story behind each one of these dots. This is where the execution comes back to play, isn't it?
Definitely. So, and we'll go in and talk to a salesperson. Hey, this customer right here, what's going on with this customer? Well, this customer, it's our first year in. They have the potential of being this large a customer. We went in with this aggressive price because they should be converting at this time, and their price will naturally migrate up, their volume will naturally migrate up, and they should move out to this right-hand side. Likewise, we'll go and talk to the sales rep who deals with this customer, and that's paying an extremely high price and is extremely high volume. Well, they're a great customer. I mailed them in the price increase every year. They take the price increase. It's great. But if that customer were ever to get approached by another competitor, we might be in real trouble. It's extremely high volume, extremely high profit, and we might not be able to pass a red face test. Why are we charging you such a high price? So everyone has a different story. And the thing that we get to is, a salesperson might understand all the dots within their portfolio and how they're going at it. But as we step back and look at this as a company, we can't even, it's very hard to justify what we're trying to do as a company or what the strategy that we're trying to execute as a company from a strategic pricing perspective.
It's like a novel or a book with 1,000 stories built within, and all of a sudden you can't understand how it all plays sometimes. Isn't that the case when you take that one step back and look at the big picture?
Totally agree. And the two things that we try to get across is one, definitely the 1% is here, and you can find a lot of the one
Yeah.
percenters in here. But number two is, as we as a company or as a corporate group step back and look at this, and we can't necessarily decompose the story, as we put this in our sales team's hands, how are we expecting them to execute this if we don't necessarily have those proper guardrails in place or a clear action plan on how to go out to the market with this pricing?
Yeah, I think that's the key, and we see that all the time when we're thinking about the execution. Is that the story might be clear from certain constituencies in your company. It may be clear at the finance team. It may be clear from the executive position, or even at the highest level of the CRO, the Commercial Revenue Officer or Chief Revenue Officer. But if we don't translate that story and understand the uniqueness to each of those individual dots, it becomes a challenge to find the 1%. You're kind of constantly selling short, if you will.
Definitely. And as we talk about, we've kind of dimensionalized what the 1% is and that it's there in the portfolio. There's a lot of things that get in front of companies, and we hear a lot of the same kind of trends or obstacles that people run into. And won't run through all of them, but rationale that, hey, we're not the market leader, we follow competition, or we don't necessarily have the people in place to do that type of work, or our industry is extremely elastic, or we lack the data, or we're a commodity. We just follow the market.
I love the one that I see in the middle there, and that is my business is so complex that I have to have unique answers at every point in time. I think that one connected to the lack of data are the two I hear all the time, especially in sort of omni-channel or multi-channel complex manufacturing organizations.
Yeah, and we often hear that out of organizations who tell us, you know what, we have 300,000 unique SKUs. So everyone's a unique pricing decision, so we have to do it based on cost. But as we look at just the size of prize around getting it right and finding those 1%, it's often something that we're like, you know what, yes, you have these challenges, but we need to find a way to get through them, because this is the amount of ROI that's there. It's just something that you need to figure out, because if your competition does, they're going to be able to unlock resources that you won't be able to deploy.
That's right. I like what you've got on the right-hand side of this chart, Avi. We've talked about this before, and we're going to get into a little bit more detail. Pricing is a team sport in terms of how this plays, and I think that's the thing that is crucial. Although each has its own philosophy: sales, marketing, finance, ops, corporate. You have to kind of interlock those philosophies to come up with a kind of a common destiny, almost, if that's the case.
For sure. And often we find if there's not a good strategic pricing process in place, that everyone has their own divergent opinion on how pricing should happen. So depending on where pricing's sitting, there's a lot of conflict around it, a lot of emotion around it. And if you're not able to have a good process supported by data, supported by the analysis, it's really results in kind of that scatter plot that you're seeing on the prior chart, and pricing being all over the place.
So, Avi, tell me,
Sure.
when we think about this and think about what organizations are doing, what do they do? What do good practitioners do in terms of setting price, thinking about this as a sort of a programmatic approach? What's the way to think about this if you're going to start tomorrow from scratch?
Yeah, definitely. And that's a great segue, Kyle, because we're going to talk about just that in terms of how should I think about my offer? How should I think about setting my price and working it up? So we're going to start from, and I apologize, we're going to go back to economics 101 here a little bit.
Don't apologize, Avi. I was an econ major. That was one of my, that's one of my disciplines. This all makes sense when it's on paper, doesn't it?
It does. So we've got quantity along the vertical, we've got price along the horizontal. If we've got one price in the market, basically the revenue that you're getting is this blue box right here. Now, as we look at it as an organization and we're thinking about, hey, as I'm trying to grow, where are my opportunities? If we were able, what we're looking to do is all this white space that's under the line, this demand line right here, these are customers that we could have served. And if we were able to go ahead and have different price points or different offers in the market, we start to capture more of this white space. So this is really what strategic pricing is all about. How do I capture this white space? Because if I capture that white space, I got more customers, more revenue, more profit at the end of the day. And let's kind of peel that back. So we were talking about, well, how do companies price? Typically, and as we find companies that are in their infancy, they start with cost. They then plow on, hey, I want to make a 30% profit margin. This is kind of interesting because often when we talk to companies, we're like, well, 30 is good. Why not take 31 or 32? The next thing is, and these are where the good companies are thinking, they pile on their discounts to their calculation as well. And then bang, I've got my price. And it's very, we're kind of navel gazing, but we've developed our price. What's the problem is that the customer's value is not necessarily dependent on how you source your products and how you ship through your 3PL and what kind of distributor programs you have in place. It's based on a lot of other things. So we're trying to figure out that value line.
Yeah, and Avi, on this, I mean, there's two things that really jump to mind. Is that I hear it all the time. My price is cost plus, and maybe cost plus whatever, some sort of percentage from last year. We've got to add price because that's just the expectation. We know that's disrupted, regardless of the current economic environment, regardless of pandemic, non-pandemic, or commodities fluxing in and out. Price is going to be really highly volatile depending upon all those things down below. In particular, if you look at discounts and the partner programs that are out there to drive your discounting strategy. So all of those things still miss that gap between price and value, right?
Definitely. And where we try to go back to is what does drive value for your customer. So as we're trying to figure out where that dark line is, we somewhat have different levels of needs. So the first kind of level of needs, or we call table stakes, it's you're meeting my spec, you got a good price, you're compliant. But oftentimes we find that the B2B purchase decision, it's really being made by higher level needs, functional, easy, how you're helping them do business, or how you're driving them from an individual value perspective. So for example, if you're helping them take cost out of their system, if you're helping them increase the security, stability of their business, or you're helping create simplification, or you're helping bolster their reputation. What this is critical about is you really have to understand these deeper level needs and how your product helps them so you can structure offers and make sure you have your right level of price in the market at the end of the day. But it's really getting to this deeper level.
Avi, I'm getting actually an interesting question coming in through the question box, and folks who are on the call right now, feel free to continue to use that. Question is this, and basically I'm going to paraphrase, is things on the left seem very quant oriented, very kind of either binary, yes, we're ethical, yes, we're compliant, or here's a quant of where we are. Things on the right seem to be more qualitative. And I think the question is essentially asking, how do we prioritize those qualitative elements? What do we do to try and understand what a buyer is interested in, but then secondarily, what is it that we can actually do to drive or capture that value?
Definitely. So on the left-hand side, for sure, this is very quant. And as we talk about economic items in terms of how we help them from top line growth or reduce costs, that's very quant too, in terms of if we understand them, we can run the business case. But you're right. All these elements over here are, we get it more into the more qualitative. So let's talk about how we start to work our way through and bring some process and some hard analytics to help drive us there. So the first thing we need to understand is, if you remember those capturing that white space under, and we kind of drew all those boxes, is we want to start building segments of customers. Good pricing is always built on good segmentation. And there's kind of 4 key levels that you can do segmentation on. Typically we see that companies look at, hey, what's the size of my customer? What's the industry? Sometimes they're looking at where's the customer located as well, or how long's that distributor been with me, or what's the size. We find that as you think about that prior chart, that this psychographic or behavioral segmentation from a pricing perspective is much more important. And what we're looking at in that is we're trying to understand things like, how widely does a customer buy across my portfolio? How long have they been with me? How much do they depend on my customer service? How much time do we spend with them in their organization? Those sorts of things. So we're starting to drive towards more of those right-hand side elements. And once we're able to group our customers like that, what we're trying to do, and I know there's a lot of data here, so I'm going to try to walk you through slowly, is if we can create these segments, we go ahead, and this is just an example here, and we've got segment A, B, C, D, and E, and we've got these segments sized based on how many of our customers are sitting in each of these segments. When you actually do that segmentation work, as we're doing that segmentation work, we're not only collecting, well, how price sensitive are those customers based on how they reacted to price in the past, or what types of things they're buying, or what combination of things they're buying. We're also trying to collect those other elements on the importance elements. So off to the right that we were talking about. So, and this is just an example, and we're saying, hey, content and quality are kind of the key things. So for segment A here, they really are looking for, they're not looking for much content or quality. They really are looking for a high content and quality. We've got these kind of backwards here, and they've got very low price sensitivity. So segment A here, you know what? They're a very small segment, but we're going to give them our premium price offer. Likewise here, the segment E, they are extremely price sensitive. They're a transactional buyer, and they're going to trade off on content and quality very quickly between us. So they are going to have this discount offer here, but we're going to need to go ahead and shift our offer. So what you're thinking about as we're thinking about these 1, 2, 3, 4, 5, one, that they're fitting to a customer segment, but number 2 is that each of these offers here, we're stripping out something from our offer. So this is kind of our premium offer. It's meant for customer A here that really wants high content and quality. As we go to this segment 2 offer here, we're thinking about things that we can strip out from our content and quality. So we're giving that customer a trade-off. Do they want a lower price, and do they go into offer 3, or are they willing to pay the higher price? But by setting up this sort of structure, we're making it much easier for the sales team to just present the offers, and then the customers can self-segment versus the customer driving and the customer saying, hey, I want your offer 1, but I want it for what you're offering for the price number 5.
Right, and Avy, I'll tell you, in particular for us at the Alexander Group over the past 12 to 18 months, and especially accelerated in the last several months, we're seeing 2 things really emerge. And item number 1 is this sort of true understanding of buyer behavior and buyer behavior changing, and it's agnostic of price. People are looking for interaction points that are different than they were in the past. These different value segments align with different behaviors that people are interested in. So doing a good buyer map or buyer journey map is crucial, because it's not just one stakeholder procurement that you're talking to. You're talking to a whole ecosystem of people who are involved in the buying decision. So that's one thing that we help organizations with a fair amount. The other thing that I'd say is that you're exactly right. If you can think about these segments based off the value you're delivering, you can set up service level agreements appropriately. So not just the sales team interacting with the buyer, but it's the post-close service team. It's the things that we do for our clients who really appreciate that quality piece. Maybe we give them more resources. So again, understanding the buyer journey ties it back to then how we can sort of segment prices and set our expectations going forward. Not necessarily making it easier for our sales team, but making it clearer so that focus can drive the performance as opposed to the other way around.
Yeah, and just building on your comments, Kyle, two things. One, this on the left-hand side, this changes over time. So exactly what you're saying, your customer journey and the sizing of the segments and what's important to them based on what's going on in the environment, it changes over time. So you need to keep on looking at it. And exactly that, as you talk about thinking about what services are included and what services are not, like these customers that are in item 5, well, if they do want the customization service, well, we're going to monetize that service to them. Here's how much they're going to pay per hour, and they're going to have to trade off. Do they want to think about paying on the higher levels or whatnot? But it just makes it a much more conscious discussion and clear discussion in terms of where we're drawing lines.
Mm-hmm. Yeah, I think it's interesting. I think there's so many nuggets here to take away that this is not just a monolithic view. There's not just a single answer, but you have to be kind of clear on where to go. I guess the question is how do you keep score? How do you begin the process? What does it look like in terms of setting this up and knowing that it changes over time, but secondarily, or B, where do we start if this is new to us or if this is something that's fresh?
Yeah, fair enough. The first thing is, and we take it back to what's driving performance. And typically, everyone's going to be familiar with what we're looking at on the left. We looked at one already, an income statement. So I'm going to just run you through it really quickly. We've got Q1 20 versus Q1 2019. The average price was actually up by 5%. We took a bit of price. Our sales, we dropped by 6%. Our revenue was down by 2%. We gave a little bit more discounts to try to prop up the revenue. Our net sales were down by 2%. Our cost of goods sold, we won a little bit of good news, actually. We saw a bit of good news. Our SG&A, we saw a bit of good news too, but at the end of the day, profit got pretty hurt. Mm-hmm. Now, often as business leaders, we're kind of sitting in the seat saying, wow, our profits are down 11, and it's kind of like a spaghetti, right? It's tough pulling this apart. And in this discussion, I don't know how familiar it is to everyone, but what's driving profits down 11? We took too much price. What do we do now? Well, let's do some targeted price decreases and certain customers and promotions. Okay, let's go hit the next quarter. The problem that we find is
that's the cycle that we see in the QBR all the time. It is what happened. Let's go fix it right now and go back at it. So
exactly, it's so high level, and where we get to is that as we talk about the spaghetti, one of the best business leaders I actually worked for, it was back in my ABI days, but he said, this is all spaghetti. To understand it, I'm going to have to pull apart every string to understand it. And as we were thinking about those spaghetti pieces, it's we've got multiple products, services, offers. We've got different channels. We've got different brands and lines. We've got different customers. We've got different regions. We've got different salespeople. We've got different distributors out there. We've got different tiers of service. So all this different complexity, we have to be able to pull that apart and decide how we need to look at our business. And as we think of each of those elements, they break into 3 big groups. One is price. Clearly on price changes and discounts, how did that perform? Number 2 is mix. So as we think about volume shifting in the portfolio, so as I'm talking about volumes moving out of our wholesale channel and is moving into our distributor channel, or moving into our cash and carry channel, or is moving into our direct channel. We sell all those at different price levels. What did that impact us? Volume moved out of our enterprise customers and they moved into our regional customers. How did that impact us? So that's another grouping, or it moved between different brands. And then we've got volume, pure volume. What did that drive to the business? Were we gaining or losing volume at the end of the day? Being able to separate your results into these key three areas and understand what's driving it. So we're going to recut those financial statements into a little bit of a waterfall. So now we've started 2019 with our $1,250 million of net sales. We've actually improved in terms of our price. We said we took a 5% price increase. We got $3 million worth of our rate. We spent back $9 million in terms of discounts. So at the end of the day, we were negative in terms of our price. We sold into better channels. That drove $2 million of good news. Our lower tier brands actually sold more, and we lost in our premium brands. We've lost $16 million there, and we dropped $7 million worth of volume. So that's how we walked our 1,250 to 1,223 million. Now, if we have this level of visibility, it changes the dynamic of the conversation and how we're going to try to target our actions. So kind of focusing on that big bar, the negative brand mix of 16 million down, well, maybe we should be changing the price gap between the different brands, or maybe we should be thinking about which brands we put our marketing spend on, or what we're going to be introducing new SKUs into, or what we're going to be focusing the sales team and comping the sales team on. But it really changes the focus on where we're going, how we're doing it, and where we're going to put that spend and how we're going to drive the organization.
It's as if you've actually just changed the scorecard to some degree. You know, kind of flipping from a typical income statement to something that now we have true action against at this point. We've got 5 buckets to pick from. Where are we going to focus our time and effort? Is that a fair statement?
It's a very fair statement. Often, you know, we'll walk into companies and they'll tell us, hey, I take a price increase every year, clockwork, like you were saying, exactly, Kyle, right? We'll go in with our price letter and we'll find that, hey, we're giving it back, but it's not necessarily that we're giving it back across the board. We're giving it back in certain customers, or we're giving it back in certain areas or in certain product lines. And by having that level of granularity, it really refines the corporate approach to start to thinking about segmentation, like we talked about. Where's our value sitting, and are we offering is our pricing in the right spot, and how we're executing, is it in the right spot? So really changes the dynamic.
Yeah, I think that's the key, is that it gives us something that can be the source of truth that we can all wrap our arms around at that point, because you've got marketing, you've got sales, you've got your service or your inside operations team, obviously finance is involved, and now the CEO has a story to tell the board, or to tell to the street if, you know, a publicly traded company. We got something we can focus on if we are able to cascade it this way. And then again, this is where pricing strategy set up with this segmentation model meets pricing execution. How do we actually go and grab that price that we're trying to go for?
Exactly, and I think the other thing in terms of the scorecard, it creates accountability, right?
Yes, yes.
If we went ahead and, you know, pretend we say, you know what, we're going to put more marketing spend on the premium brands. Well, if we spend that money in market and it's not shifting our brand mix, we're having a different discussion. But at least it's very clear to kind of pull apart that spaghetti really quickly, and we can see, are we seeing the ROI, or are we not seeing the ROI from what we're doing?
Hey, Avy, I'm getting a second question pop through here, and I think it's another really good one, because you start thinking about this. You go from rate, which is, call that finance, discounts, which could be your channel, you know, channel mix, obviously, and brand mix, 100% marketing and sales. Volume is going to be everybody's worry, especially those who are in ops who can't maybe right now keep up with demand. You got a lot of different constituencies here. Who owns this process? How does this typically work? Who should you know, who should be responsible for strategic pricing?
And at its infancy, we'll exactly like you said, it's going to be really a financial calculation in terms of just cost. But as organizations evolve, exactly like you said, this needs to be a team sport. You're going to have the sales team that needs to get engaged on this. You're going to have the marketing team that needs to get engaged on this, your revenue growth management team that needs to get engaged on this, and that capability needs to bring those teams together to be able to execute on this. So it's not necessarily it's going to live in one spot, but in order for the organization to take action against this, it is really a team sport with everyone working together.
Yeah, and I guess the question I've got for you, who typically sponsors it whenever this is going to be an effort that's going to happen? Is it the CRO, the CEO? Is it a head of finance, or where do you typically see your engagement model at Revenue Management Lab start?
Yeah, and you remember those jigsaw pieces around finance, marketing, and everyone having a different opinion? Where we typically find where we start is whoever owns that P&L and who's responsible for delivering that P&L, they're typically our sponsor, because they're able to cut across each of those functions and those channels to say, hey, we're going to look at this in a bit of a different way to and we're focusing now on the entirety of the business, both the top and the bottom line. So typically it is kind of the CRO. Sometimes if it's the VP of sales that's responsible for the P&L themselves, and they're kind of responsible from top to bottom line, or it's the VP of marketing or the president or CEO or CRA, but it's more so usually where we're coming in is whoever owns that P&L and is responsible for delivering results, not only the top line, but also the bottom line. That's who we're kind of working with through the organization.
Yeah, I think that's it, and it's typically what we would see as well. This is the evolution of where things are going, tying it all back to the buyer journey, and those different kind of criteria of value that people are seeking. It is somebody at the top who has to drive this, but it is everyone underneath who's going to follow. And I think this is one place, as we're starting to think about, what next and how to take this and go forward. This is one place where the data can help you, and the data is getting good and it's clean, and we can start telling very crisp stories that not just backs the anecdotal, but it actually gets to the point where we can say, do X and get Y.
Yeah, and the great thing about this is some organizations will say, I don't have the data for this, but as long as you have your invoicing and you have transaction level data, you can build this in some form or fashion.
Yeah,
so
I think that's what I was trying to, that's what I was trying to get at. Yeah, it's like you don't have to have perfect data. In fact, Six Sigma data here is a bad idea. You want to get good, get lean, think 80-20 to get things moving.
Totally agree. Like even at the high level, if we know we're taking price increases and we're spending it all back, who cares if it's 3 or 5 and 3 is we're spending back 7. We know we've got an issue at the high level. How do we go ahead and tackle that, right? That's right. On the more granular level.
That's right. That's right. So Avi, I mean, it always surprises me how fast these things go. We've got about 5 minutes left here. Sitting in the audience, and I'm hearing this, I can imagine just the head nods that are happening. Where do we go from here? What do people typically do? How do you get going, and what would you suggest?
Yeah, fair enough. So we think based on what we put across to you is sitting back and asking yourself 3 questions. The first question would be, when's the last time we evaluated our customer segments, and what granularity was that at? And can I fit those customer segments to my offers cleanly? And thinking about, has that changed over time? So that's kind of the first piece. And if you're kind of saying, no, I don't have that level of visibility or that level of granularity or that level of clarity, you probably got that 1% on the table that we're missing out on. Yeah. The second item is, and we were talking about those, your functional elements in terms of how that B2B value buyer is looking at things, and more of the qualitative elements. Do I have a clear understanding for those different segments of customers? What is driving the value? Are we selling stability? Are we selling reputation? Are we selling accessibility? What is it that we're giving them at the end of the day? Are we getting rid of headaches in their business? Or is this purely transactional? What's driving that value, and do I have a clear understanding of that to make sure that where I'm setting that black value line, that I'm comfortable and confident for each of those segments of customers on where I'm setting that value line? And if you're not comfortable with that, or it's more of a gut feel, again, you probably have that 1%. on the table that you're not taking advantage of.
And I tell you, one of the things that we're seeing, and this is across all sectors now, is it's not just what is the product or service we're providing, but what is the outcome we're delivering. And as we can start to determine the outcomes for our customers or our clients and our clients' clients, you can begin to really express that value to anybody who's going to be within any of the segments you found out in the first bucket there.
Totally agree with that. Mm-hmm. And then the last section is, if you look at your financial performance, and can you decompose your financial performance into the drivers? And when we were talking about drivers, one, what's going on with price? Number two, with mix. And when we talk about mix, it's kind of what is important for your business. So channels, salespeople, product lines, custom versus non-custom SKUs, distributors versus wholesalers, thinking about all those different cuts, and how I try to think about those different cuts is two things. One, what level you make decisions at in your business and where you put resources within your business, or how you're thinking about where you're placing your roulette bets within your business. That's how you want to be cutting your performance drivers, to make sure where you're putting your dollars is driving growth within your business, or at least addressing the biggest structural elements within your business. Mm-hmm. So with those three, we'd recommend is sitting back, asking yourself those questions. And if you've got uncertainty around those questions, you're probably leaving money on the table. And there's a lot of, in those 1%, you know, if you can have them drop to the bottom line, you can do the math on your own financials, but it's material. It's definitely going to be material.
Avy, again, this has been fantastic, and I'm always learning something from you when we have these conversations. So it was excellent to hear from you. Excellent to think about those three major questions that people should be asking themselves. And I guess I'd call on anybody who is listening in today, you know, for additional insights, for additional questions around strategic pricing, or how do you execute appropriately, or what do buyer journeys look like. Those are the things that we work with each other on, work independently, but we also feel like this is a really interesting topic, and hopefully you've learned something today. I have certainly, and Avy, I appreciate the time. It's been fantastic.
Thank you very much. Appreciate it.
Yeah, we'll stay in touch and keep care, everyone. And thank you again. Please continue to keep an eye out for future events, webinars, and other things that we'll be hosting, and certainly look forward to hearing from you all soon in the near future. Take care. Have a wonderful day. Bye-bye.
Take care.